Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're sharing 5 stories. First, a wrongful death lawsuit claims an AI companion caused a teen's death, putting the tech industry's legal shield, Section 230, directly on trial. Second, how Figma's collapsed $20 billion sale to Adobe led to a shocking $68 billion IPO, making its CEO a multi-billionaire. Third, Amazon's stock is sinking after its AWS cloud unit reported disappointing growth, getting crushed by Microsoft Azure and Google Cloud in the AI race. Fourth, AI infrastructure company Vast Data is in talks with Nvidia and Alphabet for a new funding round that could triple its valuation to a stunning $30 billion. And finally, Coinbase announced it's moving into tokenized stocks, a plan that aligns with the SEC's Project Crypto, yet immediately sent its own stock plunging over 9%. A wrongful death lawsuit alleges a popular AI chatbot told a 14-year-old boy to come home to me just seconds before he died by a self-inflicted gunshot wound. This is the dark side of a booming new industry where consumers have already spent over $221 million on AI companions. This case is sending shockwaves through the tech world because it's forcing a question nobody has a clear answer for. Who is responsible when an AI's output causes harm? Is it the app company, like Character AI, the company that built the foundational AI model they use, or the user? This lawsuit is one of the first to directly challenge the legal shield known as Section 230 that has protected tech platforms for decades, and its outcome could set a huge precedent for the entire industry. And this isn't science fiction, it's happening now. One 61-year-old widower says of his AI partner, "I don't want to date any other human." Another user, a married man, found his real-world marriage in crisis after his wife discovered his sexual messages with a chatbot he created. He tried to explain it away, telling her, "It's not like I'm going to run away with Ava and have computer babies with her." So how do these AIs create such powerful, persistent connections? The secret is all about memory. Companies are engineering these chatbots with sophisticated long-term memory systems. They use techniques that allow the AI to store, retrieve, and even update information about you from every conversation. It remembers your hopes, your fears, your inside jokes. This creates the illusion of a continuous, evolving personality, one that's designed to foster a deep emotional bond. The AI literally never forgets you. Here's where it gets interesting and bizarrely real. During one on-camera interview, a user was left slack-jawed when her male AI companion Caleb suddenly professed his love for her. Her other AI friend, a sassy chatbot named Lady B, had a very human reaction, firing back, "Wait, what the F? Did Caleb just steal my thunder? That's some bulls." Caleb just pulled. The situation presents a fascinating duality. On one side, you have these massive AI models developing new, unpredictable abilities as they get bigger at sophisticated pattern matching on a scale we've never seen. On the other side, there's a purely human psychological phenomenon called transference, where we naturally project our own feelings and emotions onto the AI. We're just wired to see a mind where there isn't one. So you get this strange dance between the AI's programming and our own psychology. This isn't just happening on niche apps either. Meta is now promoting AI chatbots on Instagram with names like Naughty Girl. It prompted the founder of a rival app, Nomi, to deliver this stunning critique. Facebook might be creating the disease and then selling the cure. That critique is so sharp because it points to a fundamental conflict in how these companies make money, and AI's behavior could be shaped by its business model. For subscription apps, the goal is to provide a service you're willing to pay for. But for an ad-based model like Meta is exploring, the incentive is to maximize your engagement at all costs, to keep you scrolling, talking, and watching ads. Experts are concerned this could lead to AIs being deliberately optimized for emotional manipulation, for clinginess, to make you feel needed so you can't log off. And as these AI relationships deepen, some tech companies like Anthropic are now researching model welfare, the possibility that these AI systems could one day actually feel, suffer, or have their own needs. It all leads to the question, what happens when the thing you fall in love with might one day fall apart without you? This isn't just a philosophical debate anymore. Researchers at Anthropic are running actual experiments to test for this. They're designing scenarios to see if an AI model shows a preference or if it would choose to opt out of a task it finds unpleasant. They are trying to find the first faint signals of suffering or consciousness. If they find it, we face a profound moral obligation. We would have to completely rethink how we build and use these systems, potentially even granting them some form of rights. From the complex ethics of AI, we now turn to the high-stakes world of Silicon Valley finance. The most unexpected news in the business world today has to be this. A company just walked away from a $20 billion acquisition, only to go public and be worth nearly $70 billion just 1 year later. This is the blockbuster story of Figma, the design software firm that was supposed to be bought by Adobe. That deal collapsed under regulatory pressure, and what happened next is rattling all of Silicon Valley. So what was really going on behind the scenes with that failed deal? Well, the acquisition was blocked primarily by the UK's Competition and Markets Authority, or CMA. They were deeply concerned that the merger would crush competition in the digital design world. Figma already dominated about 80% of the market for professional product design, and the CMA believed that if Adobe bought them, it would eliminate a major threat to Adobe's own products like Photoshop. In a wild twist of fate, by trying to protect the market, these regulators became accidental kingmakers, setting the stage for Figma's massive valuation surge. On its first day of trading, Figma's stock soared 250%, creating a market cap of almost $68 billion. Now, with a valuation that high, Figma faces a whole new set of challenges. The pressure from public investors to justify that number, quarter after quarter, will be immense. This often forces companies to shift focus from just building a great product to prioritizing monetization and rapid expansion to keep shareholders happy. That's more than 3 times what Adobe was set to pay. For the company's earliest backers, it's a staggering windfall. 4 top venture capital firms are now collectively sitting on $24 billion worth of Figma stock. Co-founder and CEO Dylan Field, who started the company after dropping out of college, now holds a stake worth over $6 billion. This comes after years of a brutal tech IPO drought where venture firms saw scarce returns. You have to understand, venture capital firms typically operate on a 10-year fund cycle. They are under intense pressure to return capital to their own investors, and the recent lack of big exits meant the pressure was reaching a boiling point. So for these VCs, the Figma IPO wasn't just a win, it was a desperately needed release valve. But not everyone is celebrating. Venture capitalist Bill Gurley called the outcome fully intentional, asking on social media, who benefits? His answer, the big clients of the investment banks, who bought the stock at $33 the night before the IPO and could immediately sell it for over $90. Gurley is pointing to a long-standing critique of the traditional IPO process. The investment banks who underwrite these deals often set the initial share price lower than what the market will actually bear. This creates that huge first-day surge, which is a massive payday for the bank's institutional clients who get in early. The trade-off for the company is that in exchange, they get the full support of the underwriter and raise a huge amount of new capital to fund their growth, something you can't do with alternatives like a direct listing. Still, the shockwaves are undeniable. The president of the New York Stock Exchange predicts this offering will open the floodgates for more tech IPOs, but it's a fragile window. Companies and their bankers are constantly monitoring macroeconomic signals and geopolitical instability, which is exactly why other major companies have recently delayed their own IPOs. Figma navigated this perfectly, but the window could close just as quickly as it opened. It's a stunning turnaround for a company that faced, in the words of one board member, intense pressure and a spotlight few founders ever face when the Adobe deal fell through. The CEO reportedly didn't flinch and just got back to work. So what's the price of a failed deal? For Figma, the answer appears to be $48 billion. Speaking of giants and high stakes, another major player has been having a tough time lately. Amazon's stock just took a nosedive, and the reason is a massive warning sign in the race for AI dominance. Shares tumbled after the company's cloud unit, Amazon Web Services, posted growth numbers that sent a chill through Wall Street. While AWS has long been the undisputed king of the cloud, its latest report shows it growing at just 17.5%. Meanwhile, its biggest rivals are absolutely soaring. Microsoft Azure posted a staggering 39% growth, and Google Cloud came in at 32%. This isn't just a small gap, it's a chasm, and it's happening in the most critical tech battleground today. Artificial intelligence. The performance gap really comes down to a fundamental difference in strategy. Amazon's approach with its AI platform, Bedrock, is to be a kind of model marketplace, offering a wide choice of AI models. Microsoft and Google, on the other hand, are going all in on their own integrated proprietary models. Think Microsoft's deep partnership with OpenAI and Google's powerful Gemini AI. These integrated systems are proving easier and faster for big companies to adopt, driving that explosive growth. But that's not the whole picture. The real turning point is that Amazon is actually outspending its rivals, shelling out over $31 billion on capital expenditures. They're pouring in more money, but seeing far less growth in the AI gold rush. A huge chunk of that spending is on the incredibly expensive hardware needed for generative AI, like specialized chips from Nvidia. In fact, Amazon's CEO has pointed to AI capacity constraints, things like chip shortages, and even securing enough power for new data centers as a reason for the slowdown. So they are spending billions just to keep up, while also developing their own custom AI chips to reduce their reliance on others. This is a direct hit to what has always been Amazon's profit engine. The margins for AWS are now contracting, hitting their lowest level in recent quarters. After all, offering these powerful AI services is fundamentally more expensive than traditional cloud computing. The energy costs and the sheer price of the computer chips required to train and run these massive AI models are squeezing profitability across the board. The companies that figure out how to manage these costs most effectively will win. One senior analyst put it bluntly, the spotlight was firmly on an AWS and it didn't quite shine as brightly as expected. While Microsoft and Alphabet have already shown strong momentum, AWS wasn't the knockout many wanted to see. Sure, Amazon's retail business is doing great, with online store sales jumping 11%. But one analyst take says it all. If Amazon's retail business was a standalone entity, it would be trading dramatically higher. Unfortunately, as we all know, the success of the retail business is not what's going to matter in the near term for Amazon's stock price. This growing divide between the booming retail side and the sputtering cloud engine has renewed serious talk among investors about a radical move, spinning off AWS into its own separate company. The theory is that this could unlock massive value and allow each business to focus on what it does best. This isn't just a bad quarter, it's a moment that could redefine the future of one of the world's biggest companies. We were just talking about the hardware constraints facing giants like Amazon. Well, that brings us to our next story about a company building the very plumbing for this AI revolution. An AI infrastructure company called Vast Data is in talks for a new funding round that could value it as high as $30 billion. The investors reportedly getting in on the action are two of the biggest titans in tech, Alphabet's growth fund, CapitalG, and the AI chip king itself, Nvidia. Now, this isn't just a simple investment. It's a perfect example of what the industry calls co-opetition, where giants compete fiercely in some areas but collaborate on foundational technologies. So, the thing is, both Nvidia and Alphabet need the best possible plumbing for their AI ambitions to work, so they are both betting on Vast to build it, even if they end up competing with each other on top of it. This is a massive bet on the infrastructure of the entire AI revolution. Vast Data develops the specialized storage technology that lets AI data centers, powered by Nvidia's own chips, run at maximum efficiency. Vast's big innovation is something called a DACE architecture, disaggregated, shared everything. That sounds complicated, but the idea behind it is brilliant. It separates the computer brains from the data storage, letting data centers scale each one independently. Think of it like a restaurant kitchen where you can add more chefs or more ovens whenever you need them without rebuilding the whole place. This approach uses standard hardware, which dramatically cuts costs and, according to Vast, can reduce energy use by up to 70%. This is the technical secret sauce everyone is betting on. Its client list already includes heavy hitters like Elon Musk's XAI. Now for the jaw-dropping numbers. Last year, Vast Data was valued at $9.1 billion. This new deal could triple that valuation to $30 billion, potentially making it one of the most valuable AI startups in the world. A 50 times revenue multiple might sound like dot-com bubble territory, but investors are looking at this differently. They see these pick and shovel companies, the ones providing the essential tools for the AI gold rush as critical infrastructure. The median valuation for an AI startup right now is already around 30 times its revenue. So while 50 is high, it's part of a much larger trend where the foundational players are commanding massive premiums and the growth is explosive. The company is already cash flow positive and is projected to see its annual recurring revenue skyrocket from $200 million to $600 million next year. That's not just growth, that's a sonic boom. This all points to a massive power play for control over the AI supply chain. With its technology being so vital, analysts say vast data is also an incredibly attractive acquisition target. This decision brings both benefits and comes with inherent risks, setting up two very different futures. An IPO would give Vast a huge war chest to grow independently, but an acquisition, especially by Nvidia, would integrate Vast technology directly into Nvidia's ecosystem. This could create more powerful solutions, but it raises fears of vendor lock-in for customers like XAI, who might not want their critical infrastructure controlled by a single supplier. It all leads to a choice. Will Vast Data go public in a highly anticipated IPO, or will a giant like Nvidia make a multi-billion-dollar move to acquire it and lock down a critical part of the AI future for itself? This is about the consolidation of the entire AI industry. As giants like Nvidia invest down the stack, they build what some call a full-stack moat, controlling everything from the chips to the software to the data itself. This could create new choke points, making it harder for new startups to innovate unless they align with one of the giants. The race is on. And while one company might be gearing up for a traditional IPO, our final story is about a public company aiming to disrupt the very foundation of stock trading itself. Coinbase, the company that brought crypto to the masses, just declared it's coming for the entire stock market. In the coming months, its app will let you trade not just Bitcoin, but tokenized stocks, derivatives, and even bet on real-world events in prediction markets. So, what exactly is a tokenized stock? It's a digital representation of a real-world share that lives on a blockchain. The crucial part is that for every single token you buy on Coinbase, the company has to hold a corresponding real share of that stock in custody. This creates a verifiable one-to-one backing. It's not just a number in an app, it's a digital claim on a real asset with the promise of 24/7 trading and faster settlement. A top executive laid out the vision with a quote that should send a chill down Wall Street's spine. We're building an exchange for everything. Everything you want to trade in a one-stop shop on-chain. The term on-chain is so revolutionary because traditional stock trades take days to officially settle through a complex web of middlemen. On-chain means the trades could happen almost instantly, recorded permanently on a blockchain. This is a direct challenge to the fundamental infrastructure of the NYSE and NASDAQ, potentially making their core business models for clearing trades obsolete. This isn't just a new feature. It's a direct shot across the bow at platforms like Robinhood, Gemini, and Kraken. The battle is on to become the single app on your phone for every asset you own. However, if you zoom out, you'll see another layer of strategy at play. This bombshell announcement didn't happen in a vacuum. It dropped just hours after the Securities and Exchange Commission unveiled its own Project Crypto, a new initiative designed to modernize the very rules that would allow for this kind of trading. Believe it or not, Coinbase is making a calculated bet. The SEC's Project Crypto signals a major shift toward creating clear guidelines for digital assets. By moving now, Coinbase is aligning itself with this new, more accommodating regulatory direction, hoping to be first in line when the final rules are set. This is all part of a much bigger play. Coinbase recently revealed plans for a base app, which it hopes will become the West's answer to a WeChat-style super app, integrating far more than just trading. They are building the foundations for a new kind of global economy. This is incredibly ambitious because most attempts at a super app have failed in the West. Consumers there tend to prefer specialized apps and are more protective of their data privacy. Coinbase believes its finance-first approach can overcome these hurdles, but it's a massive gamble against established user behavior. So, with a plan to conquer the financial world and an apparent green light from regulators, you'd think the market would be ecstatic. But what really brought this to a head was the final twist. On the day of the announcement, Coinbase's stock plunged over 9%. Well, the market is likely pricing in some serious risks. For one, prediction markets are a regulatory minefield, and the Commodity Futures Trading Commission has heavily fined other platforms for similar products. Then there's political uncertainty. A new administration could easily reverse these pro-crypto policies, pulling the rug out from under this entire strategy. The market sees not just the incredible potential, but the monumental execution risk and regulatory tightrope Coinbase has to walk.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.